Good morning, and welcome to Investment Talk TV. And now, with the latest information on the stock market, your investments, and retirement opportunities, here is LPL Financial Advisor Paul Meyers.
Hey, a big good morning to you wherever you are out there in TV land. This is Investment Talk TV, brought to you by the licensed LPL Financial Advisors at Legacy Wealth Management. I am one of those advisors. I am your host today, Dave McGatlin, sitting in for the great Paul Meyers, who is out on assignment, being that it is Easter. So happy Easter to all of our viewers, all of our clients, wherever you might be watching. Happy holiday to you. It's been a great 3-day weekend for those of you that got the kiddos that aren't in school. That's always fun. No shortage of news in the stock market, no shortage of news in general, all kinds of things going on. But before we continue with the rest of the show and all of that fun stuff, I'm not alone here in the studio, so I am with the one and only, the other advisor, LPL Financial Advisor, Mr. Devin Beal. Good morning to you, sir.
Good morning, Dave. Good to be here, and happy Easter to everyone out there watching. Hope everybody's able to spend time with friends and family today and hopefully eat some good home-cooked meals. Now, let's talk about a little bit of local sports news. UND hockey team made it to the Frozen Four, so they'll head off to Las Vegas, and on April 9th, they'll play the Wisconsin Badgers, and the winner of that game will advance to the national championship. And what I think is pretty remarkable about that is head coach Dane Jackson is in his first year as head coach. And interestingly enough, the last time UND advanced to the Frozen Four was in 2016 when they won the national championship. And head coach Brad Berry at the time was also a first-year head coach. And he was the first coach to ever win a championship in his first year. So maybe we can see history repeat itself and watch UND bring home a national championship.
How awesome is that? Hey, I went to UND, so my alma mater, I'm rooting for them, so go UND. You know, it's funny because the last time they won, I was actually back at UND, so kind of a fun story there. So good luck to the UND men's hockey team. We're all rooting for you. Other things going on in the sports world, baseball. Obviously, opening day was last week, and the season's rolling. And the automatic ball and strike challenge rules that is being implemented now in 2026, giving the teams the ability to challenge the old balls and strikes call that has been so much of a staple of baseball. Been extremely interesting to watch the strategy on that. And there's been a lot of umpires that have kind of, you can tell they don't really like being challenged like that, but hey, adds a whole new interesting dynamic to the game. And other things going on in the news, not in the sports world per se, but in the science realm of things. Artemis 2 earlier this week, as of this recording, has not launched yet, but it is supposed to. So Artemis 2, for those of you who don't know, NASA's heading back to the moon, not necessarily landing on it. I think they're supposed to do a fly around and come back, but great to see more than 50 years later, the United States and NASA heading back to the moon. So very, very cool things. Hey, in all seriousness, though, this is Investment Talk TV. So wherever you are, if you've got questions about your retirement, because we know that you do, because hey, you're watching this show, right? If you've got questions, whether you're planning for retirement, you're just about to retire, in retirement, or even just basic investment questions, we're your help desk. We're always here to help. So feel free to give us a call. Your number there on the screen, or our number, 701-365-8083. And you can always shoot us an email as well. team@legacywealthfargo.com. In case you missed this episode, you can binge watch us on the old YouTube. You just want to go to the search bar there, search in for Legacy Wealth Fargo, and we should be the very first one to pop up, and you'll see our smiling faces. You can revisit all of our previous episodes and keep watch, or as they say, binge watch, right? Well, without further ado, we got a lot of stuff to cover today, so let's move into our very next segment where I get to kind of do a little blast from the past with This Week in History.
Whatever mankind must undertake. I have a dream.
Well, we're going way back in time now, over 100 years ago. April 6, 1917, the United States officially enters World War I. 2 days after the U.S. Senate voted 82-6 to declare war on Germany, the U.S. House of Representatives endorsed the declaration by a vote of 373 to 50. As a result, America formally enters the side of the Allies in World War I. By the conclusion of World War I, a year and a half later, in November of 1918, more than 53,400 U.S. servicemen lost their lives killed in combat. with another 63,000 plus that unfortunately passed away due to non-combat related deaths such as disease. However, shortly after the conclusion of World War I, the U.S. stock market in 1921 would go on one of the strongest bull markets ever recorded in U.S. history, averaging more than 20% per year during that 7-8 year stretch up to that fateful day known as Black Monday, where the stock market crash of October of 1929 leading into the Great Depression. But 20% a year, Devin, that's incredible. I would love to have a bull run like that, wouldn't you?
I certainly wouldn't complain about that.
Yep, absolutely.
All right. Hey, speaking of that, we got a lot of show left for you. With that, I'm going to let Devin turn it over to Devin and kind of go through the agenda and what we got going on for the rest of the show.
That's right. First, we'll take a look at our stock market snapshot and see what's going on in the market. And we'll do 5 points in 5 minutes. And our main topic today is bumpers and buffers, a legacy wealth deep dive into buffered ETFs. We'll talk about what they are and how they can help clients navigate growth versus risk. If we have time, we'll look at our viewer mailbag, and then we'll look at our stock market week in review.
Awesome. Yeah. Well, we don't want to delay. We don't want to, solve any time here or shorten ourselves with any time talking about those buffered ETFs. So let's go ahead and get started. Let's take our look at our stock market snapshot. Boy, Devin, I tell you, we say it every single week. The market's volatile. Oh my gosh, there's no shortage of news. Well, here we are again. We're going to say the exact same thing. Definitely no shortage of news. What are you seeing going on in the market? What's the first thing that pops out to you?
Well, we're kind of doing the peace talk hokey pokey with all the volatility based in Iran. It's a lot of up and down. And we've actually entered correction territory on the major indexes, including the NASDAQ, Dow, and the Russell 2000, meaning they're 10% down from their all-time high. Although this week, we've seen them recover a bit in a positive direction, so we're trending in a good spot.
And I think that has a lot to do with, you kind of mentioned it, we joked about it last year, and we kind of, portrayed this joke every now and then, was the tariff hokey pokey. We're putting the tariffs in, we're pulling the tariffs out. Now it kind of seems to be this peace talk hokey pokey, where the peace talks are in, the peace talks are out. Obviously, we're referring to the U.S. And Israel against Iran right now, with the Strait of Hormuz being closed down to 20% of the world's oil supply, which of course has caused those skyrocketing oil prices, in case you haven't noticed at the pump. Obviously kind of wreaking havoc in the market. But here recently, we've seen an awful lot of talk with the president talking about potentially coming to a peace deal with Iran. Remains to be seen. I know he was supposed to earlier this week, as of this recording, give a nationally televised speech about that particular topic. Unfortunately, we don't have that information now, but hopefully that came to a positive conclusion, or at least we're moving in the right direction. We do know, as you mentioned there, Devin, that the market did recover rather handsomely here in the middle of the week, more than 2% in some of the indexes. So fantastic recovery that we're kind of seeing. Hopefully we can stay on this trajectory and keep going in there. Speaking of that trajectory, one of the big questions that we always get asked is, what are interest rates going to be doing? And the new Fed chair, Kevin Warsh, who is basically on the docket to be confirmed by the Senate here in the month of April, no hearing scheduled for that yet. Has to get by the Senate. I believe the Banking Committee has to approve it in order to get to the Senate floor for his confirmation or not confirmed, which current Chairman Jerome Powell has said, regardless, he would be willing to stay on should that not happen. So all kinds of things going on in the stock market. So if you've got questions about your portfolio, whether you've switched jobs, maybe you're planning on retirement, you want to get a second opinion, we're always here to help. It's what we do. So give us a call, 701-365-8083. With that being said, this is one of our favorite topics that we like to move into. Our next segment we like to call 5 Points in 5 Minutes.
Every week, the advisors at Legacy Wealth Management, with the assistance of economic researcher Mick Higley, comb the economic reports, and we come up with data and information that's helpful as we analyze the markets and put together our advice. We call this 5 Points.
Well, Devin, I'm going to go ahead and get started here with our 5 points. We call this big swings, same game. On average, a given trading year sees a peak to trough decline of about 13 to 15% in the S&P 500, even in positive years. In more volatile years, the spread can widen to 20% or more between the highs and the lows. It's a reminder that sizable swings within a single year are normal, but not unusual. For example, 2025 last year, we saw a swing of 37% from the bottom of that trough when the president rolled out those tariffs, where Wall Street kind of panicked on that. But where did we finish the year from January 1st in 2025? 17% up. So yeah, definitely see those wild swings in the market. Devin, what do you got for the second part?
A retirement reality check. Nearly half of Americans over age 65 have less than $50,000 saved for retirement, leaving little margin for rising costs. Even among people in their early 60s, roughly 1/4 to 1/3 fall below that mark. It's a stark reminder that millions are entering retirement far less prepared than expected.
You know, that's wild. You really stop and think about it. Out of all the years and all the jobs that Americans have, that we enter retirement with less than $50,000 in order to go. So definitely is kind of a stark reminder to your point. Definitely want to take a look. Talk to a financial advisor. Let's see what we can do for you. Next topic we're going to talk about. Well, here's one for you. Since it's tax season, this one's reminiscent. Top tax territory among developed countries. Denmark leads with the highest top-tier income tax bracket of nearly 56% for top earners when national, local, and labor taxes are combined as a group. These rates only apply to income above the top bracket, not the entire paycheck. Comparison-wise, though, in the United States, the top wage earners pay roughly 30 to 35% in taxes. That, of course, heavily dependent upon which U.S. state they currently reside in, because obviously income taxes in different states are widely different. But let's talk about career change there, Devin.
Yeah. So the average American has 12 to 15 jobs over their lifetime before retiring. Workers often switch roles every few years early in their careers, then settle into longer-term positions later. Job changes can include promotions, career shifts, or moves to entirely new industries.
12 to 15 jobs over your working life. I mean, I look at where I am right now. I'm going to give it away. I'm in my mid-40s. I mean, I've probably had 6 or 7 jobs growing up already, so I'm halfway there. I don't plan on leaving Legacy Wealth Management anytime soon. I don't want to get to 15 jobs. That's for darn sure. So we'll take the last one here. Running out of retirement. About 1 in 3 Americans spend all of their retirement savings before they pass away. Rising healthcare costs, longer lifespans, and unexpected expenses make outliving your money a real risk. And only 2 out of 5 American households operate with a monthly budget in mind. That's according to Bankrate.com. All the more reason to kind of talk to a financial advisor, check out your situation. There are plenty of investments out there, plenty of ways that we can do those 3 pillars, that growth, that income, and that safety that we like to kind of harp on all the time. We do not want to see anyone run out of money in retirement, and we know that's a stark possibility given everything that's been going on in the market and all the different things that can happen that are unexpected. So we want to help you plan for that. So definitely want to work with a financial advisor on that. That kind of leads us into our main topic today, one of the main things that we want to talk about. Now, in no way are these buffered ETFs that we're about to talk about being recommended specifically for anyone out there. We don't know you, we don't know your situation, but we at least want to come with the information of, hey, these are investments that are out there. They can be utilized in people's portfolios, especially in retirement and those non-retirement accounts. So what are buffered ETFs? Why would we even bother to use it? So let's go ahead and talk about it. Devin, I'm going to turn to you to get started here. So let's talk about the broad definition of what a buffered ETF is. But before we even ask that question, let's go ahead and load up a little fun for you. So I created this little may or may not be artificial intelligence here. You can see Devin and myself dressed up as 1970s bowlers because the title of this main segment is Bumpers and Buffers. So we kind of want to use the analogy. It's kind of like going bowling with those bumpers on the lane. Lord knows I haven't bowled in a long time. I would probably need those bumpers, but kind of the exact same sort of analogy here, Devin, where we're talking about investing so that we've got a buffer on the bottom, but a cap on the top. Talk about that. Tell us a little bit about what those buffered ETFs are.
Yeah, so a buffered ETF is an investment that will limit your losses on your investment, and it will allow you to participate in the market, and it will grow up to a certain percentage with the market.
So very interesting kind of point. So when you say there's a buffer on the bottom, I think probably a really good idea here would be to kind of use an example, right? So let's just say somebody out there happened to have $100,000 and they're, hey, I'm interested in these buffered ETFs. So one of the things that we would do is we would buy this buffered ETF for, say, $100,000. Maybe it's $50 a share. That part's kind of irrelevant, but however much it is, how do we protect that? So when we say buffer, how far could this particular investment, and we'll talk about what that investment is in here in a second, but that particular investment, how far down could it go before we get to be repaid? How does that work?
Well, a perfect example is a 15% buffer, meaning the first 15% of your investment is protected, meaning over a 1-year period, if your investment lost 15%, this buffered ETF would protect your investment and you would be even right where you started instead of losing that 15% like the market did.
Okay, so since it's pretty close to April 1st, if we were to buy one of these buffered ETFs, and you mentioned a year, so that's an important point to remember. So it's a 1-year stretch. We call it a point to point, but 1 year later, let's say we bought into the market for $100,000 and we're covered minus 15%, which means about $15,000 of losses would be covered. So let's say a year later, the stock market is down exactly 15%. What would my investment be worth then?
It would be worth what you started with.
So $100,000.
Yep.
Okay, so it would come right back up. Okay, keeping that same lines and that same example, let's say the market kind of moves sideways, right? Maybe it's up a couple of percentage points. Nothing too wild and crazy, but it finished pretty close to where we started with. How would the investment look like then?
Again, since it's where we started and we're not below that 15%, we would be either flat, or if the market was up a couple percent, we would be up a couple percent as well.
Okay, so it's kind of following that index. Okay, well, let's take the positive side of things. Let's say the market recovers here from April 2026. Say it's April 2027 now and the market's up 15% or 20% even. How would our investment look then?
So that would depend on what our cap is. If we had a cap of 15%, then if the market went up 15%, we would get that full 15% return. Now, if we had a 15% cap and the market went up 20%, we would be capped out at that 15%. But there are a couple ways around that, isn't there, Dave?
Yeah, there is actually. I'm glad you brought that up. So let's say a really strong bull market were to come out here in 2026, or at least for the second half of the year, and the market were to be up, say, 20, to your point, 20%. Yes, we're capped at 15% in this particular example, but here's the cool part. These buffered ETFs are liquid. In other words, you can get out of them whenever you might need to. So if we're capped at 15%, there's nothing really stopping us from selling. Let's just say it's November later this year that this happens. There's nothing to stop us from selling it and then buying a new one on November 1st. And now we've reset everything. So we've gained 15%. Our investment's now worth $115,000. This is just an example. We buy back in for November, and now we're covered 15% down from that $115,000 mark. And now we go off to the races again for another year, and we just kind of rinse and repeat, right? So to the point of these buffered ETFs, we mentioned it earlier in the show, we're talking about growth and we're talking about safety. So those two things right there are being met. We're allowing ourselves to grow, but we're protecting those assets, which are so important for our clients, especially in the retirement years where, hey, I'm not working anymore. I'm not adding anymore. I want to protect what I have. These buffered ETFs could be a fantastic a choice for your portfolio. That being said, what are we exactly investing in? Well, we've got an image. We're going to put that up on the screen, but Devin, you can kind of tell us about it. There are basically indexes that we're buying. Is that right?
Yes. So it mirrors an index such as the S&P 500 or the NASDAQ. So we're really working with the basics here. A lot of investments that are really the basics when we think of the stock market. So it's nothing too crazy in terms of what we are following.
So when we're following an index, so let's give another example, right? Let's get specific. In this same example with $100,000, we could buy into, say, the S&P 500 index, right? So that was one of the options that are there on that bowling screen where we're trying to pick which lane we're going to bowl in with those bumpers, right? That's kind of the analogy here. So let's take the most cookie cutter one that we talk about all the time of the S&P 500. you're buying 503 of the largest companies in the United States, right? Hence the term S&P 500. So we're pretty diverse. We're not betting on a single stock. We're not betting on a single company or even just a handful of them. It's 500 companies, right? And we talk about it all the time. You're getting some of the really good ones, some of the okay ones, and maybe some that are trailing behind, but you're getting it as a group as a whole. But we're still covered down, in this example, 15%, still allowing some room for growth, which is pretty fantastic. One of the other questions that we get about these buffered ETFs is, hey, is there like a minimum amount that I have to put into this? Is there a maximum amount? Talk about that, Devin. What do you think?
Yeah, so there's no minimum amount and there's not necessarily a maximum amount. It will depend on what kind of account you're in. So that's going to depend on two things. That's going to depend on your current financial situation and your goals and needs for both now and the future. Because like we talk about a lot, your goals will dictate the investment, not the other way around.
That's right. Yeah, very well put. I know somebody who said that a time or two. Yep. That brings up a good point, though, because you talked about it depends on which type of account that we're in. So let's talk a little bit about that, because one of the really good follow-up questions that we get to this is saying, hey, Dave, Devin, Paul, how are these taxed? So if I sell them in my account, am I going to have to pay taxes on it? And obviously that's going to depend on what type of account that it's in. So Devin, kind of take that away. So let's just say it's like a retirement account. How are these buffered ETFs going to be taxed?
So if it's in a retirement account, it's not going to be taxed when you sell it. It will be taxed when you withdraw the money. And if it's in a Roth account, of course, it's not going to be taxed at all.
So in this example, if we paid, $100,000 in my retirement account and it grows to $115,000 and I sell it and I realize that $15,000 gain, there's no tax because it's in that retirement account. Whether it's traditional IRA, so pre-tax money, or those Roth IRAs, doesn't really matter. There's no taxes because we sold it and started a new one. But what Devin's point is when we pull that $15,000 out of the IRA, now there could potentially be a tax situation, right?
That's absolutely right. And if it's in a non-retirement account, it will only be taxed when it's sold. Now, we talked about this being a 1-year period. It doesn't automatically sell at the end of the 1-year period. It will just reset its period and keep going until we decide to sell the investment.
So that's a really great point, because in that situation we kind of described in the middle where, say, the market's up 5%, we don't really want to necessarily sell. So what happens a year later? So in this example, April of 26 to April of 27, what happens in April of 2027? Well, really nothing, except that it resets. So whatever it happens to finish at on April 1st, now we've started a new bar where it's 15% down of down and 15% capped on the upside. So if we don't sell it, there's obviously going to be no taxes because it's in that non-retirement or those non-qualified accounts. But can be a little bit confusing. We don't want you to kind of look at these on your own. We're happy to help. We're happy to answer any of the questions that you might have when it comes to these buffered ETFs. They can be used in multiple different ways, depending on your goals, depending on your strategy. I know for a fact that there are an awful lot of clients out there that we talk to on a daily basis, especially with the volatility that we've seen that's been going on in the stock market here recently with the war in Iran. We are talking about protecting those assets. And that's that third pillar, that's safety, right? We want to be able to grow because, hey, to the point of one of our 5 points, or a couple of them there actually, we don't want to run out of funds in retirement. And this is one of those ways that we can protect. So I think it's a fantastic idea. I think it's really cool to have that as an option in our retirement accounts or even our non-retirement accounts or whatever the case might be. It's definitely something that you should research and do your due diligence on, and we're happy to help with that. So if you're interested in these buffered ETFs and you think that they might be right for you, or you've got specific questions, Devin, me, Paul, we're all here to help, all the staff at Legacy Wealth Management. Give us a call, 701-365-8083. You can always email us, team@legacywealthfargo.com. Happy to help in any way that we can. We've got time here to switch into the viewer mailbag, and we're going to take a look at that. Now, Devin, I think you've got the question. What you got?
Yeah, Ben from West Fargo asks, I recently got my taxes done, and what I owed was a lot different than what I expected. Can you explain the difference between long and short-term capital gains and why it matters?
Well, that's a great question. Hey, here it is, right? Pretty much the end of tax season, right? So if you haven't filed your taxes, you better get on it. We're approaching that April 15th here pretty quick. But I believe Ben in West Fargo asked the question, what is the difference between short-term and long-term taxes, and why does it even matter? Why does it apply to your situation? So great question, Ben. We're glad you called in with it because it's a question we get all the time. I'll answer the short-term. You can talk about the long-term, Devin. So the short-term capital gains taxes, this only applies to accounts that are inside those non-qualified. So not a retirement account, right? A basic brokerage account. Basically, if you bought one share of a stock, you can pick any stock you want. Let's pick on somebody. Let's say NVIDIA, right? If you had one share of NVIDIA and you bought it, say, in January of this year, 2026, it's going to be a short-term gain or loss, depending on which way NVIDIA moves, for 365 days, 1 year, right? So if we sold it now or within basically the next 9 months up until January, we are going to incur a short-term gain or loss. How is that taxed differently? It goes to your income tax. So say you sold that one share for a $10 gain, that $10 gets added to your income tax, and that's going to be taxed at your effective income tax rate. Obviously, that's going to depend on what your total income is. But long-term is very different. Devin, talk about long-term.
Yeah, so long-term capital gains refer to anything that's held over a year. So if you buy the investment and sell it at any time after that 1 year period, you'll get what's called long-term capital gains, or also referred to as preferential rates. And unlike the short-term that's taxed at your taxable income rate, these are taxed at either 0%, 15%, or a maximum of only 20%. And that's depending on your income, but obviously 20% is lower than what a lot of people's taxable income is on any given year.
That's right. Well, I definitely know from looking at our 5 points that it's much lower than Denmark's 57% at that top tier bracket. So 20% definitely sounds a little bit better. But all that said and done, we talked about a little bit about these buffered ETFs. Again, if you're interested in those and you think that they might be right for you, definitely give us a call. We're happy to help with that. We're not CPAs. I'm not. Devin's not. Paul Meyers. We're not accountants, right? We do know the basics. We do know basically how these investments can affect your tax situation, and we're happy to help with that. We don't think that you should ever have to do this alone, and we like to think of ourselves as the help desk. So give us a call, 701-365-8083. We're almost out of time here today. We got a tiny bit of time to take a look at the stock market weekend review. We'll throw those indexes up on the screen. As you can see, boy, is there a heart monitor, right? A quick drop off earlier in the week, and then boom, rapid fire up we go. Obviously, volatility more than likely here to stay. Don't really see it going out of style anytime soon. But with that, those buffered ETFs, Devin, those can really help. We're just about out of time today. For Paul Meyers, who's out on assignment, Steve Poitras as well. I'm Dave McGatlin, along with me, Devin Beal. We want to wish you all a very happy Easter. And if you've got questions, give us a call. We will see you next Sunday.